Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing quantum computing's influence on PC sales trends. Last week's news was dominated by the numerous executive orders signed by Donald Trump. We will cover those in more detail this coming week when we've had a chance to assess their implications. In the meantime, we're having a look at two computing-related trends. Firstly, the underwhelming recovery in PC shipments in 2024 and the potential for improvement in 2025. Secondly, the quantum computing frenzy that started late last year and whether it's the real deal or another overhyped pipe dream. Now before we dive in, here's our quote of the week from John Wheeler. If you are not completely confused by quantum mechanics, you do not understand it. Now, let's talk about what's been going on in markets this week. Here's a quick summary of what's been going on. First up from the Financial Times, Beijing tells insurers to buy more Chinese stocks. What's our take on this news? Wasn't it government interference that started the rout? Chinese authorities are now setting targets for the amount state insurers and mutual fund companies must invest in local shares. The Financial Times believes that it could result in $68 billion flowing into China's local equity market. That may well lead to upside in the short term, but what will it do to investor confidence in the longer term? Markets do need to be regulated to a degree, but when regulation extends to asset allocation targets, at some point it stops being a free market. Next up from Bloomberg, currency manipulation warning sparks debate on Trump's plans. What's our take on this news? The US's trading partners are suffering from a stronger USD, but Trump wants to prevent them from taking action. The USD traded at near 2-year highs recently due to higher relative interest rates and strong growth. While this is good for US importers, it's bad for those who buy goods from the US and US exporters. Several key federal agencies have been tasked with addressing foreign exchange manipulation from other countries. Bloomberg noted that the US Treasury Department already has China, Japan, Germany, and Singapore on their monitoring list, and strategists are wondering who will be added. Basically, if a country is seen to be actively trying to strengthen its currency relative to the USD, expect the US to react accordingly. Next up from CNBC, Oracle shares rally on involvement in Stargate AI infrastructure initiative. What's our take on this news? This could be even better news for data center hardware suppliers. Oracle certainly stands to benefit from its involvement in the project. The company is also forming a closer partnership with OpenAI, which can't be a bad thing. But it's also great news for companies like Nvidia and Broadcom. At some point, the other hyperscalers investing in AI infrastructure might slow those investments. This project aims to invest another $500 billion over 5 years, assuming the money materializes. Next from the Wall Street Journal, CEOs launch war rooms and hotlines to cope with Trump's order blitz. What's our take on this news? In times of emergency, get all hands on deck. The executive orders around trade, immigration, tax, and energy policies are shaking up corporate boardrooms, or at least some of them. Consulting firms have mentioned that few companies grasp the potential impact of these changes. Given the importance of the policy changes, law firm Akin Gump even launched a Trump executive order tracker to help their clients. The incoming administration plans to shake things up in its first 100 days, and it hasn't wasted any time. Some more clarity around the implementation of these orders will come soon. Next up from Fast Company, hedge funds bet big on Trump's second term. What's our take on this news? Over-leveraging can't possibly go wrong, right? Hedge funds are leveraging to the gills, reaching their highest borrowing levels since 2010, as they anticipate the tailwinds from Trump's era of deregulation and tax policies. The Ridex leveraged bull-to-bear ratio reached 100 to 1 recently, indicating that for every $1 in a leveraged bear fund, there was $100 in a leveraged bull fund. That level is even higher than the level reached in the peak of 2021 at around 80 to 1. Many managers have reduced their exposure to emerging markets as they expect rising tariffs and continued strength in the dollar to hurt emerging market equities and companies with dollar-denominated debt. Trump, who took office on January 20th, kicked off his second term in the White House with several protectionist policies that will position America's economic interests over trade partners. With all this leveraged exposure to the upside, there seems to be very little concern amongst investors for the downside risks. And lastly, from NBC News, new potential TikTok buyers emerge. What's our take on this news? Don't they know they can get it for free on the App Store? As ByteDance faces increasing pressure from US regulators to divest TikTok, several big names have been thrown around as potential buyers. Oracle's Larry Ellison, YouTuber Mr. Beast, and the ever-present Elon Musk are all names that have popped up to throw their hat into the ring. China's softened stance on a potential sale is quite a shift back from the ban or bust standoff, but questions still remain whether TikTok's prized algorithm will remain untouched, preserving user experience. With the 75-day extension on divestment granted, TikTok will need some big money buyers stepping up to the plate soon if they want to ink a deal on the company, whose US operations are valued at around $50 billion. Now, let's dive into the main piece. Will the PC market recovery accelerate in 2025? Global PC shipments increased for the fifth consecutive quarter year-on-year in Q4 of last year, reaching 255 million units for the year. However, 2024's 3.8% increase over 12 months was much lower than anticipated. The chart below shows how the recovery that began in 2023 really lost momentum in 2024. Sales are well below the 2020 and 2021 peak, and in fact below the pre-pandemic levels too. Sales of notebook and desktop PCs shot up in 2020 as companies equipped employees to work from home and consumers upgraded their own gaming PCs. After that boom in sales, the decline in 2022 wasn't really surprising. But PCs are typically replaced every 3 to 5 years, so sales were expected to pick up again between 2023 and 2025. So far, annual sales are barely 5% above 2022 levels. Guidance from Dell and HP in November suggested both companies don't see things improving in the near term either. The slow recovery is happening across the industry as changes in market share, measured as units sold, were marginal. Gartner estimates that Lenovo gained the most market share, 0.8%, followed by Apple and Acer, both 0.3%. Most of those gains came at the expense of Dell, who lost 0.5%, and smaller manufacturers, while HP and Asus were flat. PC shipment cycles also affect the companies that supply the components that go into notebooks and desktops. First and foremost are Intel and AMD, which supply most of the CPUs in PCs. But most of the large semiconductor manufacturers, including TSMC, Samsung, and Micron, are part of this supply chain. In 2021, AMD's client segment, which supplies PC manufacturers, earned $6.9 billion and accounted for 42% of revenue. In 2024, this segment earned $6.2 billion and slipped to 25% of revenue, and that's despite gaining market share from Intel. So, here's some possible reasons for a slower recovery. There are a few factors, both structural and cyclical, that explain the slower recovery. Firstly, modern PCs simply don't need to be replaced as often as they used to. PCs manufactured in the last 10 years are robust and fast, and the compute power required by most users hasn't increased very much during that period. Increased use of cloud applications also pushes more processing power to data centers. Secondly, inflation and high interest rates have squeezed budgets for businesses and consumers. That's probably caused many potential buyers to delay the next upgrade until it's really necessary. And lastly, distributors and retailers have struggled to sell excess inventory from the last cycle. Two catalysts that were expected to drive demand in 2024 actually acted as headwinds, but that could change in 2025 or later. The first was lower than expected sales of AI PCs, and the second was the delayed Windows 10/11 upgrade cycle. Windows 10 can't be upgraded on many older PCs. Microsoft delayed the termination of support for Windows 10 to November this year, which means there wasn't as much urgency, but that's likely to change later this year. While consumers may decide to put up with the older OS, businesses usually like to stay up to date. So let's talk about that first catalyst, AI PCs. Are they the catalyst everyone is waiting for? PCs capable of running AI applications locally are a brand new category within the market. As mentioned, even mid-spec PCs older than 5 years are perfectly adequate for most tasks. That could all change if more people want to run AI applications locally. Some analysts thought that would happen last year, but the uptake was slow. In Q1, 7% of PCs shipped were reported as AI capable, and that percentage is estimated to have reached 15% in Q4. However, that number is skewed by the fact that all Apple notebooks and desktops are AI capable. There may be a lot of potential PC buyers taking a wait-and-see attitude. AI tools are advancing rapidly, but many PC users are still experimenting rather than relying on them for daily tasks. If that's the case, it's hard to justify the extra cost of an AI-capable machine. On the other hand, there's the risk of buying a new machine now and then having to upgrade again in a year or two to use tools that become essential. That could change quickly if or when AI applications become essential. Add to that the Windows 11 upgrade and the fact that companies will eventually replace all the PCs they bought in 2020, and there could be a sudden change in PC sales trends sooner rather than later. Now let's move on to quantum computing. Is quantum computing the real deal? The latest technology revolution to grab the attention of investors is quantum computing. The big catalyst was Google's announcement that its quantum chip, Willow, could perform a calculation in 5 minutes that would take a supercomputer 10 to the power of 25 years. Yes, that's 10 septillion years, a number that is bigger than the history of the universe. This resulted in a handful of pure-play quantum computing stocks taking off, some jumping over 500%. A couple of weeks later, though, Jensen Huang said quantum computing is likely to be 15 to 30 years away before being truly useful, and the same stock prices promptly halved. However, there is a strange paradox regarding the field of quantum computing. Several prominent tech industry leaders have said that really useful quantum computers are decades away. Yet, IBM, Google, Amazon AWS, and other companies currently offer cloud access to quantum computers, and they have for a while. So, what exactly are they offering? First, let's go into what quantum computing is. We're not even going to try to fully explain it because that would be a bit ambitious, but here's a version of an explanation in 50 words or less. Quantum computers use properties of subatomic particles to store and process data. Quantum bits, known as qubits, can represent multiple values at the same time, unlike the binary bits, zeros and ones, used by today's computers. Rather than performing calculations step by step, a quantum computer uses simulation and probability to arrive at a solution in a single step. If you're after a more detailed explanation, IBM was one of the first companies to invest heavily in the field. There is a great detailed explanation on their website. Alternatively, this YouTube video, which is linked in the article, explains the field in an easy to understand way. Quantum computers are being developed to solve very complex problems. This includes AI, but is particularly relevant to materials science and pharma and biotech research. The challenge is that as qubits are added, the complexity increases exponentially, which can consequently lead to errors increasing exponentially. Google has a 6-step roadmap to develop its quantum computers and says its latest chips put it at stage 3, so we're currently halfway. The company's blog post stated that our new chip demonstrates error correction and performance that paves the way to a useful, large-scale quantum computer. So, large-scale, useful quantum computers are likely to be decades away. In the meantime, there's a limited market for the early iterations of quantum computers. These existing solutions are being used for materials and life science research. Currently, the market is estimated at around $2 billion and is expected to grow to $70 billion by 2030. That's probably a moving target and dependent on how useful quantum technology becomes in the next 5 years. So, who are the companies in this space? There are a handful of companies that focus on quantum computing, with most earning very little revenue. Although, some are forecast to grow those revenues at more than 50% per year. These include D-Wave Quantum, Quantum Computing, Rigetti Computing, and IonQ. The broader ecosystem includes semiconductor materials companies like Applied Materials and those that provide equipment to the semiconductor industry. The Defiance Quantum ETF has been a lot less volatile than the quantum stocks, but that's probably because it has about 90% of its assets in the broader semiconductor sector and just 10% in the pure play stocks. In the article, we've got a link to all of the holdings. So, what's the insight here? Make sure you understand the end game when investing in innovative, loss-making companies. If quantum computing goes the way of many of the other technology innovations, it will probably be companies like Microsoft and Alphabet that capture the most value. But the profits will be gradual, and it takes a lot to move the needle for multi-trillion-dollar companies. At the other end of the spectrum, the small, pure-play quantum computing stocks could offer a lot of upside. And that's why their stock prices will probably move a lot on any positive industry news, even if it has little to do with them. Last week, an analyst more than doubled his price target on Rigetti Computing, from $4 to $8.50. As we mentioned last week, there's a difference between a 12-month price target and a valuation. For speculative companies, it's often more about the hype cycle than real valuations. Before you even consider the potential upside, there are a few things to check. Our full article goes into what parts of Section 3, Past Performance, and Section 4, Financial Health, you need to check to make sure downside risk is reduced. It's common for small, growing companies to have a short cash runway. When the outlook for the company and industry is bright, raising more cash shouldn't be a problem. But that does mean your shareholding is likely to be diluted. If profitability is likely to be years away and expenses are likely to increase considerably, shareholders are going to be diluted considerably too. This needs to be factored into whatever you think the company could be worth in the future. Industries also fall out of favor at times, which makes raising cash more difficult. Many high-flying companies in 2021 saw their stock prices fall 75%. That means new shares need to be sold at much lower prices and dilution increases further. In some cases, like the electric vehicle industry, small companies just can't raise cash at any price. Finally, in many cases, the most likely endgame for small, innovative companies is an acquisition by a much larger company. That may seem like a good result for investors, but sometimes the apparent gain doesn't actually justify the risk or the amount you get diluted along the way. This doesn't mean speculative companies are never investable, but these aspects of an investment are often overlooked. So again, make sure you understand the end game when investing in these kinds of stocks. And that wraps up this week's Market Insights. It's scheduled to be a big week for fourth quarter earnings season, as 4 of the Magnificent 7 are scheduled to report, along with large cap companies in most sectors. For the list of those companies and more of the key events during the next week, check out the article, which we'll have a link to in the description. That's all for this week. Thank you so much for listening. And until next time, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.